You are listening to Keystone's Stock Talk Podcast, episode 136. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, we start by talking about a new US ETF that has been getting a great deal of buzz or attention. The VanEck Vectors Social Sentiment ETF, symbol BUZZ, B-U-Z-Z. Apparently, the ETF is able to, quote-unquote, cut through the noise of the millions of online conversations to identify stocks with bullish investor sentiment and trade them. We will give you our thoughts. Now, in our Case for, Case Against segment, we take a look at TFI International. It's a North American leader in the transportation logistics industry, operating in Canada and the US. The case for will be done by Aaron. The case against is argued by Brennan, and I will sit in as judge, jury, and executioner. In our Your Stock, Our Take segment, we answer a listener question on Cameco Corporation, symbol CCO on the TSX, one of the world's largest uranium producers. The company's shares have performed well at the start of 2021 following renewed optimism in the nuclear power market after doing little but decline for around 10 years. We will let you know whether the move or not in Cameco is sustainable. I'd like to welcome my two co-hosts again this week, Brennan and Aaron. How are you two doing?
Doing well. Salutations.
Doing well. Yeah.
Yeah, we have...
Looking forward to this this debate coming up here that I have with Brennan.
Brennan, your thoughts on that?
It's been a little while since Brennan and I have squared off. You know, he's... he's getting better. A little bit better every time.
You had that Greco-Roman wrestling match in the office, but we won't talk about that. You squared off there, but you mean in the intellectual arena, right?
Yeah,
in terms
I'm looking
of
to win this one. Yeah, the wrestle didn't go too well for myself, so just kidding.
Well, Aaron did study jiu-jitsu, right, Aaron? So.
Yeah, it wasn't really necessarily that good, but good enough to beat Brennan anyways.
No, you kind of just held your hand out there, right? And he was coming at you, and there wasn't much going on. Anyways, we'll not remember that anymore at any point in the show. Now, we're going to say that we got our April webinars coming up, April 6th and April 13th. Tickets will go on sale next week for those. Our November ones sold out, so we encourage you to get them fast once they go up. We'll have some more news on that on the next show. Let's dig in.
I just want to say, can I say something about the DIY?
Not really.
Because it's almost surprising that you brought it up, that it's, the next rounds are coming up again. But we've already started thinking about the content and how we're always looking to make it better and really adapt it to what's going on currently as well, so that, investors can get a good idea of how to situate themselves in this kind of market. So really looking forward to it.
Yeah, and we'll talk. We're just going to talk about a fund right now that typifies some of the things that are going on in the market right now, and we're going to comment on some of these in this seminar, like provide some real advice on which ways to go and which ways not to go in the market in terms of investing. And now the VanEck Vectors Social Sentiment ETF, or BUZZ is the symbol. So it's a social sentiment ETF with 75 holdings currently, monthly rebalancing. It's been promoted by Dave Portnoy of Barstool Sports fame. Now, this is coming directly from the creators. I'm going to read a little statement here. They say, "We are experiencing a monumental moment, within the history of retail investors. Twitter, Reddit, StockTwits, and dozens of other platforms have established communities for investors to discuss stocks And as a result of soaring online engagement, they have become an alternative data set for investors to scour and utilize for a performance edge. Now, I would take a little issue with that. There's been decades of online information, amateur bloggers and non-amateur bloggers, analysts out there posting content in individual stocks. But I would like to see the data set that backs up that over a long-term horizon, any investor can get a quantifiable edge by reading a Reddit blog or seeing a Twitter meme on an individual stock. I'd really love to see that data set. But anyways, to go on in this, with the promoters behind this ETF, they say Buzz empowers individual investors to potentially benefit from the predictive insights gained by measuring the collective convictions about stocks, ultimately building the benchmark for social sentiment. Look, I get using more and more data in investing, that it's smart, but in my opinion, this is really not investing. It's momentum trading. Historically, most attempts to trade sentiment and momentum just do not perform well. It looks like, another firm using buzzwords here and a hot market to raise capital and charge a 0.75% fee from it, rather than doing really difficult, hard work to create value on behalf of their clients, to find great businesses, to grow their clients' wealth over the long term. So, I got more comments on it, but I'll let you guys, if you've got any.
Yeah, so if I could just dig into it a bit. So, like you said, it's a social sentiment ETF. It has monthly rebalancing, and they're holding about 75 stocks in the ETF at one time. So, my first comment is just that is a lot of stocks. Now, something that I should also add is that for a company to be added into the ETF, it needs to have a $5 billion market cap. Now, of course, all of us know GameStop, AMC Entertainment, Bed Bath & Beyond. These are basically the gold standard of meme stocks, at least for the time being. And essentially, none of these stocks would have been added to the ETF because their market caps weren't over $5 billion. So, you would have been buying them when it's possibly too late, especially where, you would have possibly been getting into GameStop when the stock price was over $100, which, at that point, I wouldn't have touched it with a 10-foot pole, because, of course, I don't have a great outlook for GameStop and buying video games in store. But yeah, so, essentially they're not getting into these stocks when they're at the level that, they're taking off from, essentially. They might be added to the ETF when it's too late, which definitely scares me, especially if, there's a lot of social sentiment around it, because I would assume that, if all of a sudden GameStop was trading like it was, that stock probably would have been added to the ETF based on the index.
Yeah, to me, sentiment investing, literally, this is about, in some respects, investing with the crowd. And crowds aren't always wise. In fact, some can be the opposite. Take, for instance, the frenzy of investors participating in the stock market bubble, like a one that occurred, say, in the late 1990s, the dot-com boom. The group or crowd involved in this bubble invested based on speculation that internet startups basically would become profitable at some point in the future. Many of the stock prices soared, despite the fact they had not generated any revenue. They had .com behind their name. A good portion of those companies went bankrupt, or never became anything, or went to a height and then lost 80% of their value. The crowd was investing in those companies. In the short term, the crowd, and in the mid and long term, the crowd was not right. So many of the most, and I just look at our investing strategy, and this couldn't be farther from what we're looking for. Many of our most profitable investments that continue today to make our clients wealthy come from investing where the crowd was not. I think Wayne Gretzky, I'm not saying he's the greatest investor of all time, but he famously said, "I skate to where the puck is going to be, not to where it has been." There was literally no coverage, I repeat, no coverage on Boyd or Expel when we recommended them to clients over the past decade. Now, Boyd has been the best performing stock in all of Canada over that last decade. Expel is one of the best performing stocks in the entire country, and now in the US over the past 3 years, up 3,000 plus percent. Boyd is up 10,000 plus percent. No social media momentum algorithm could have led you to these life-changing investments. I, for one, would remain skeptical as to whether this fund can outperform over the long term.
Yeah, I'm very skeptical.
Okay, yeah. So, I'm just learning about this right now. I find it, very interesting, and there's a few points I want to make. So, first of all, I think it's absolutely brilliant from a marketing perspective. I mean, I'm sure
it's all about raising
they're
money.
Going to make a lot of money. It's going to attract a lot of attention. It's going to attract a lot of capital. So
this is what VanEck does, though.
I would ask. Sorry, Ryan?
I mean, VanEck has in the past done things on cutting edge development of ETFs. It's sentiment based kind of creation of a financial product that can raise a lot of money. And that's what's gone on here, in my opinion.
Right. So looking at the just the performance numbers, so I can see here the index that they created, they're quoting a return of 58% for a year compared to the S&P 500 of 18.4%. So I noticed that the ETF only launched this year. So a question, I have not looked and verified this myself, but a question that I would have they have their index going back 5 years. Was the index actually constructed publicly 5 years ago using the same algorithms that they're using today? Or is this a back-tested return? So I don't know the answer to that, but that's really important to know. Because if they created the index, or they created the algorithm and then they back tested that, so compared that, essentially determined how the algorithm would have performed historically if they had implemented it in the past, i.e. if they had a time machine. That's a step in the process of validating a model, but that's not the end, right? So it's that would be something that's really interesting to know. But one thing I'll say, I mean, I'm looking at the top 10 holdings. Some of these are okay companies. You've got Facebook, you've got Apple, Netflix, Amazon. So to the extent that a sentiment analysis can direct you to some decent companies, I think that's fine. I would want to know exactly what other types of filtering they're doing. I know that they're only investing in companies that have a market cap of 5 billion or more. So that's one filter, but are they also using other filters like whether or not a company has revenue, obviously not profitability because most of these companies aren't profitable. So that would be something to know. But what is really important to understand about algorithmic investing, I mean, sentiment analysis, I absolutely think it's an excellent tool as a part of your toolkit, but to rely on that as essentially your sole indicator for whether or not to invest in a company, and I'm not saying that they're doing that because I haven't looked at their model. But if you're just relying on sentiment indicators, that's going to be really problematic. You're setting yourself up for a lot of risk. Now, one thing that people really have to consider is when in the world of quantitative or algorithmic investing, there's something called an alpha factor. So this is essentially an indicator, something you can calculate that you believe is a driver of returns in a stock. That's an alpha factor. So for them, they're saying a sentiment analysis, which will essentially result in a score, a sentiment score, is their alpha factor. And they're using that alpha factor to essentially determine what the future return of a company is going to be. That's essentially what they're trying to do. Higher alpha factor typically would mean, higher ranking in the list. But in quantitative investing, once you discover an alpha factor and you implement it, other players in the market start to see this as well. And then they start to emulate it. So it turns from an alpha factor into what is called a risk factor. This is, basically quantitative investing 101. I'm not a quantitative analyst, but I like to learn about these things. It turns into something called a risk factor. And a risk factor is something that explains the volatility or how a stock or an investment moves up and down, but not the returns that are driven. So essentially, when you find a good quantitative indicator for your model and you implement that, more than likely over a period of time, other market players are going to implement it as well. And they're going to drive all the inefficiency out. They're going to drive all the return out of that alpha factor, turning it into a risk factor, which is not useful to determining, returns of a stock or what you're thinking a stock is going to return, because everybody knows it, because everybody can use it. You essentially lose your competitive advantage. So this is a highly public. Now, if they have the absolute best algorithms out there, who knows? But this is certainly a risk that I think people should consider when they're looking at the past returns of this ETF and wondering whether or not they can extrapolate that going forward. Now, to the extent that a sentiment analysis can direct you towards some really interesting companies, I have no problem with it. I would use that. But once it provided me with those companies, I would then want to look at those companies and drill down and apply some other analysis as well.
Yeah, and just using that singular method and singular way of identifying companies, to me, is not doing enough analysis if you want to invest long term. Perhaps if you want to trade, and this fund is going to continue to trade in and out on a monthly basis. But I do also see a problem, and I can see people taking some arbitrage opportunities if they set a certain date that they do a rebalancing every month. Because if you can start to emulate their model that they're using, and they're going to move from one company to the next, sell and then buy, I mean, they could start to have an influence if this fund becomes larger and larger. So anyways, I think there's a bunch of things to watch with this and see, like, look back over 5 years from now to see how well this Vector Social ETF or Buzz ETF does over the next 5 years. That will be really proof in the pudding, and we'll see how it does over that time. Kind of as a departure from the way we would look at the markets, for sure.
Another thing that would be great about sentiment analysis, just as a toolkit in your analyst toolbox, is when you find a company you really like, you could run a sentiment analysis on it. And if the sentiment on it is negative, that doesn't necessarily mean that you don't invest in the stock, but it means you need to find out why it's negative, what people are talking about, what they're concerned about, and determine for yourself if that is a reasonable risk. Yeah,
because the crowd can be wrong and right. So, I mean, and you have to make that judgment yourself. It's certainly a tool you can use. I don't know why you'd want it to be the only tool in your toolkit box, and that's kind of the only tool that this fund is using right now. So let's look at TFI International, TFI or TFII on the TSX. Currently trades at $90.77, market cap around $8.5 billion. So what does the company do? TFI International is a North American leader in the transportation and logistics industry. It operates in Canada and the US. It operates in the package and courier less than truckload, and logistics segments. Are you guys ready for this case for and case against?
Oh, yes, yeah. And I would like to say that I did give Brennan the pick. We didn't flip a coin. I decided to let Brennan decide what side he was going to defend. So
didn't my coin flip come up the same way anyways?
No.
Okay, so we could have went the other way.
We could have went the other way. Yeah, but no, I appreciate it, Aaron. I taking one for the team. Going against your
I thought you wanted this case.
Well, no. I did want this case. I'm just saying that he's allowing me to take the easy W here, is what I'm saying. And go against his bet that I was going to lose. What's your bet again? More than 50% of the time.
More than 50%, or no, more than 75%.
So something like that. But either way, it's just this is going to be like taking candy from a grown man, I guess I could say.
Well, partially grown man.
But yeah, all right, tough guy. We'll see what you got.
Mentally, we're not sure about that. Okay, well,
the talk is over. The talk is over. Now we're actually going to
let's get to it.
About
the gloves.
So I'm just going to run the clock here. 1 second. This makes for good. Okay. Now, who's going to go first? Case against or case for?
Doesn't matter.
Case against. Okay, Brennan, you go first. 4, 3, 2, 1, go.
Number 1, top line revenue growth has stalled, coming in at $3.48 billion in 2020. 2019 and 2018, and after fuel surcharges, revenue has actually declined 4% over the 3-year period. Number 2, profitability margins are increasing, but this continued margin expansion is not sustainable over the long term to drive the stock share price. And diesel fuel costs have increased over 30% in the last 5 months alone, which could put negative pressure on margins in the future. Number 3, TFI has a lot of debt on their balance sheet, coming in with net debt balance of $1.2 billion, which isn't too concerning, but with the recent increase in prime rates, TFI's debt service is likely to become more expensive in the future. And number 4, the company is currently trading with an enterprise value to EBITDA multiple of approximately 14 times, showing that TFI is rather expensive considering the business offers no top-line revenue growth. And how much further can margin expansion drive the share price going forward? Not much, in my opinion. Boom.
Okay, there we go. Nice. Just under the wire.
Interesting.
Aaron, are you ready for the case for TFI?
I am ready. Yes.
All right. Let's get this going then. So 4, 3, 2, 1, go.
Strong momentum and strong financial performance recently. Net revenues were up 18% in the last quarter. Earnings per share were up 36%. For the full year, revenue was stable. Earnings grew 11%. 2, essential service benefiting from the e-commerce trend. TFI is a transportation and logistics company, which is essential to the e-commerce industry. This is a trend that we expect to remain strong, and TFI is benefiting from that growth. 3, substantial acquisition activity fuels future growth. TFI strategically made 13 acquisitions in 2020, 5 in the fourth quarter, 2 already this year, including the transformational purchase of UPS Freight. 4, healthy balance sheet, debt to equity of 0.7 times, debt to EBITDA of 1.8 times. 5, valuation is not unreasonable. TFI's stock trades at 16 times free cash flow, 21 times adjusted earnings. In this market, come on.
Ooh, with 10 seconds to spare, too. Just dropping the mic there. Impressive.
Honestly, hearing both sides.
Maybe I spoke a little quickly.
That was good, though. That was good. Hearing both sides, honestly, it's tough. It's tough. Good job, or good luck, Ryan, and good job, Aaron.
And it's good that we have these contradictory perspectives on a stock, because sometimes even when we're in the office, as part of the research process, if somebody likes a stock, we'll ask somebody else to take the devil's advocate position, and this is a very small example of something like that, but it's interesting. And Brennan, you are right. Revenues over the last 3 years, I would go off of net revenues over revenues before the fuel surcharge. But yeah,
no, that
all
makes
right.
sense.
Well, we've said our piece.
Yep.
Yeah. Well, no,
luck,
I would say this one is one of the closer races that we've had on here over the since we started doing the case for, case against, bull case, bear case on a company. TFI. The margin expansion worries me that it could come a little bit down with the diesel prices going up. But that transformational acquisition gives me reason to be more optimistic. I do like the fact that they are, participating in the e-commerce boom, the logistics of that. I would think right now, it's a company we have already discussed in the office. So it's, it checks off a lot of our criteria. I'm going to have to give the win to this one on Aaron. To Aaron.
Wow.
What do you have to say for yourself, Brennan?
Brennan.
You know what?
It's
right.
literally razor thin on this one. I'm going to say it's razor thin.
I agree.
And EV to EBITDA multiple of 14. If the margins come down, then that kind of gets in question. But it's not, in these markets, it's not that expensive if we do expect growth this year and next year from that acquisition. If they could bring up some more organic growth. Now, it's really, and you could make the case too that, if you look back at them over the last 3-4 years, I would like to have seen more growth.
Yeah, I'm going to say something. So here's the thing. It pays a dividend. This is actually on my monitor list for income research at Keystone, but I haven't recommended it. So in a way, I can't be too hard on Brennan because, but I think that going through this again, with the acquisition, it's something that we can look at again. I don't think the balance sheet is over leveraged. The valuation, it just depends. 16 times free cash flow, 21 times earnings. How sustainable is the growth? Can they get the organic growth going? Can they maintain the acquisition growth? But I will tell you this, and this is the funny thing about the market. 2 years ago, trucking logistics was the most boring business for investors. I mean, people, analysts were saying, oh, it's too competitive. There aren't enough barriers to entry, potential margin pressure. People didn't like it. They didn't like the sentiment from analysts, generally speaking, on TFI was not good. There was a lot of negative sentiment. Now, all of a sudden, through the pandemic, e-commerce, this is part of the infrastructure of getting supplies to people's houses when we're all shut in. It's the most exciting business, apparently. And they're starting to trade at higher valuations.
You're saying maybe it will soon be included in the Buzz Social Sentiment Index because of all the positive social sentiment we're seeing about it. I don't think it's going to be in there in any time. But yeah, I
might have exaggerated a little bit when I said it's the most exciting sector out there. But it's definitely the sentiment on something like trucking has definitely, anything that's associated with e-commerce, associated with benefiting from the pandemic, just generally, is generally seen in a positive light. Now, the question is, does the growth continue post-pandemic? How dependent are they on acquisitions? These are questions that have to be answered. So I took the forecast on this. I'm not necessarily telling everybody to buy it. I think it is a good company. I think it has a lot of good fundamentals. It's something we're looking at.
This is the type of debate, like why I like this one, is the type of debate we would actually have on this company in the office. Probably not putting it down to a minute on each side. Go a little longer in the regular form of our debate, but like this is what we look at, and a company that we would look at. Would try to figure out if the growth path can continue, the margins can continue at these levels over the long term. We have some doubts on that, and there's a real argument to me that they can. So, it's a company that we continue to look at. So we're splitting hairs a little bit on the win or loss in that company.
If I could even say, just like a flaw of my case here is I'm only looking at past revenue growth as well, historical, whereas like realistically, I should be looking forward. And that's the thing, I agree completely with Aaron, 14 times EV to EBITDA, you said 16 times cash flow, that is, growth at a reasonable price. If going forward, these acquisitions, can, increase that line for growth going forward. So no, I completely agree with the decision. And this was one of the funner ones because I truly didn't know which way it was going. So yeah, good job, guys.
Okay,
and,
well,
I'll remember that, Ryan.
Yeah, let's switch gears to our Your Stock, Our Take segment. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. And a question came in on Cameco Corporation, symbol CCO in the TSX. Currently priced at 2023 and market cap of just over $8 billion. So what does Cameco do? It's one of the world's largest uranium producers. The company's flagship McArthur River and Cigar Lake mines are located in Athabasca Basin in Saskatchewan, Canada, basically in Brennan's backyard, I heard. So, it's true. Now, recent news. What is driving the share price gain? Well, the stock has gained 42% in the past 6 months. We believe that the energy transition theme is feeding into increased investor interest in nuclear power, combined with the potential that the new Biden administration takes a more friendly stance toward the sector generally. This could provide nuclear utilities with increased confidence to return to uranium term contracting market. In our view, the challenge for investors is assessing the time frame over which this evolving scenario could play out, and if it does continue to go the route, and if more people continue to go the route of nuclear power. Now, in the interim, the uranium market has actually started off the year quite quietly. The spot price has slipped below $29 US a pound level for the first time since April of 2020. The pricing environment currently is not great. So in conclusion here, now I'm going to put this generally. What do we look for in a great investment? Here's a couple things. Historically, we want strong revenue growth, a path to revenue growth going forward, profitable growth with the potential to increase profit margins over time. A strong or well-managed balance sheet is what we look for. These are some of the things we look at. In the case of growth, we look at whether or not the growth is organic or from accretive acquisitions skillfully executed by management. There are many other factors, but this gives us an idea of whether or not the business has been well run and there is a growth path ahead of it. Now, in the case of Cameco, over the last 4 years, revenue has declined. So for 4 years, in 2017, did 1.15 billion. Last year, 1.8 billion. Operating profits have gone from around 300 or 237 million to a loss last year of 40 million. That's not inspiring performance. So as an investment or a bet in this case, Cameco comes down to whether you think the nuclear power market will be where it will be 5 to 10 years from now, and your confidence in management's ability to manage its mines and grow over the long term. If you're positive on these, then it could work out in your favor. The operating performance over the last 5 to 10 years really gives you no indication that this company is worth investing in. Again, if it's a bet on uranium long term, which is uncertain, and Cameco's holds mine-specific risk. If I was bullish on this sector, on the nuclear power sector long term, I would maybe spread a bet out over a uranium ETF might be better than on one company that's going to face significant losses again in 2021 and has that mine-specific risk to that company. So for us right now, we'd be sitting on the sidelines with Cameco.
Yeah, it makes sense.
Brennan, you're going to take the 4 case?
On Cameco, no, probably not. But
well, the 4 case could be, I think uranium's going up long term and the nuclear power market is the place to be. Like literally that's the case. There's not much else you can say. I mean, Cameco's the best managed company in the sector. I don't know how you show that from, looking at the business, but the 4 cases, if the price of uranium goes up over the long term and more
I will
nuclear
say,
power, and you could make that case.
Like their MacArthur project, or their MacArthur, I guess, mine, they ended up closing it, I believe, temporarily suspending operations because the price of uranium was too low. Now, again, I don't know this sector inside and out, so I might be, talking through my teeth here. But from my understanding is in, I believe early 2018, they ended up suspending the operations just because, uranium was at such a low, and they thought, to help support the price going forward, they were going to close it, for just the time being. So, that is a huge risk. If all of a sudden, this is just a common theme that you're going to hear us talk about at Keystone, commodity specific risk. It's not something that you can predict, which, is a little scary as an investor. There's no doubt about it. But, yeah, especially when all of a sudden a company goes out and says that they're going to suspend some operations at a mine just because of the price of a commodity has taken an adverse turn,
I mean, just to give you the forward-looking multiples on Cameco right now, 2022 expected, the EV to EBITDA is 96 basically, and the price to cash flow is 90. So for a business that really isn't, it has had declining revenues. You're just betting on more nuclear power plants being built over the next, 3, 5, 10, 20 years. If that's your thesis, then it would be something you buy and you better put that away for 20 years. And as those come online, maybe the price comes up and this company does better. For us, it's not the way we invest. We're not betting on a major theme. The theme seems to fit in with a business that we already see is growing its cash flow, is returning us capital, is, creating value over, the near, short, mid, long term, all those things that we look for. And we have a path of growth ahead and it fits in with the theme. That's fine. We're not going to buy a stock just for the sake of a theme that may or may not come true into the future. It's a bet and it's not a good way to invest long term.
No, if I were to just come across this company on one of our screens, if I were to just, without knowing anything about it and just look at the financials, there would be nothing there that would encourage me to continue research. I don't follow the commodity markets very closely. I just did take a look at the uranium price here, and yeah, it's been up and down, but it hasn't really. It's basically where it was about a year ago. So I'm not sure what the company. I can't really visualize the growth path for a company like this, so it's not something I personally invest in.
No, and there's just so many other good businesses that we can see out there, even right now, that have growth. They're trading at relatively reasonable prices. We see a growth path for them going forward. And if we can add 15 to 25 of those businesses to our portfolios, our clients' portfolios over the long term, that's what we're trying to do. If we just take a bunch of bets on a future event occurring and add all those stocks to your portfolio, you look back 5, 10 years from now, I don't think you'll be happy with that portfolio. I believe you have a fighting chance to be very happy with the portfolio that's consisting of, that profile of company that we continue to beat people over the head with over the long term. And that's what we do for our clients. And that's what we try to do for ourselves when we invest as well. Yeah. So I hope that that'll end our show. Any comments, closing comments from you guys? You got anything else to say, or are you going to get the hell out of here?
We should tally up to see if Aaron's bet is coming true here, to see how many losses.
No. Don't. No. Here's the thing about that. It's
3 months.
This reminds me of somebody who wants to calculate the returns, at every point throughout the year. I mean, obviously you can just look at your brokerage statement, but honestly, it's a 1 year prediction. Let's give it a year. No point in looking in, checking in on it every week. We give it a year. We take a look at the end of the year, and otherwise it's just a distraction. And I don't want things to turn out. I don't want things to turn out worse. I say we could look at something on a 6 month. How about 6 months? So I'm looking out for Brennan here.
6 months. 6 months. We'll look at my record, and I'll be over 25.
I have a good feeling about next week.
Hey, I don't want pity wins.
Nothing to base that on.
No. Hey, you want to know what, Brennan? You've been doing this for 2 years. Ron and I have been doing it for almost 20. So
that is valid, and I've learned a lot
more than
from
20
you guys.
For Ryan now.
Yeah, it's been fun.
Yeah.
It's been fun.
Yeah.
It's good. Okay, well, we will close the show out this week. Keep your questions coming into our Ask Us Anything, Your Stock, Our Take, Case for, Case Against segment. Any suggestions you got? Continue to rate and review us on iTunes. Go on there. We're going to have some special promos for doing that over the next couple of weeks. So continue to do that. And again, keep those questions coming in. And I wish you all out there stay safe and profitable investing. Thank you.
Profitable investing.
Thanks, everyone.